battling the relentlessly negative doom and gloom news media. It's the Nick Stenger Show, coming to you live from the Stenger Family Office headquarters. It's your host, Nick Stenger.
All right, ladies and gentlemen, welcome back to the Nick Stenger Show. My name is Nick Stenger. We are the Stenger Family Office. For the past 42 long years, it's been our mission to deliver both clarity and confidence to help secure your financial future. Welcome back to the 135th episode of the show. Hard to believe we are already done with Investor Day. It came and went very quickly. Thank you to all of you who attended, whether you came to Sullivan's on Tuesday night or joined us all day on Wednesday for the presentations. I hope you enjoyed it. We had some spirited debate on one of the sessions, and I even mentioned it in my closing remarks that that's really what makes this country special and unique, is that we can agree to disagree. We can have our differences of opinion, but we can all come together at the end of the day and really function as a democracy. And I think that's really neat. It was obvious, at Investor Day, and we had speakers from kind of all over the place, different backgrounds, different views on the economy, which is really cool. That's what we try to do at Investor Day, is to give you an inside window into what we listen to when we do our rebalance and our due diligence process. You don't want to just hear one side of things. You don't just want to hear one opinion. You got to hear multiple opinions, and then you can come up with your own ideas and formulate your own decision-making process. But I think a lot of people listen to one set of ideas, and they only make decisions off of single factor analysis, and that can be very dangerous, especially when it comes to investing. So that's really the beauty of our rebalance process, of the due diligence system, where we meet with 25 third-party asset managers. We take all their opinions into account. We want to see what the best and brightest are saying and get a sense for, is there a common theme? Are there some trends going on in the background? And then we go away, we huddle as a group, our Stenger Investment Committee, and make the final decision. And so we've done that now. We have made the final trades and decisions in the portfolio. On Monday, November 3rd, we processed those trades. So all of the things that Investment Committee voted on, our Investment Committee, we actually went ahead and Charles Schwab and traded that. So you should have received alerts if you're in the exchange traded fund portfolios and saw some activity online that said you've bought such and such fund and sold another fund and so on and so forth. If you have any specific questions on that, that's obviously just for clients only, but if you have any specific questions on that, call us. We're happy to talk through it anytime. And then the other thing I would encourage you to do is, this is actually the very first year in 42 years of history that we are able to provide you with a replay of Investor Day. So all of the sessions will be available online. We're actively working on that. I'm hoping to have it out sometime next week so that you're able to listen to those presentations, see exactly what we talked about. I had one of the keynote presentations. Bond Roth had a presentation discussing the changes. We had a couple of guest speakers, like I mentioned. And then the other one that I think was probably the most highly well-received, well-reviewed session of the day was actually our family office panel. And so if you're a client of ours, or you're not a client yet of the Stenger Family Office, and you're wondering, well, what is a family office? How do all these things kind of fit together? Why do I need to have tax? Why do I need to have estate planning all in one place? Well, I think that family office panel will really give you a nice window into what we do. So you'll hear from Bond Roth, you'll hear from Audrey Feldposh, who's a certified financial planner with our group. You'll hear from our head of tax, Chris Jordan, estate planning attorney, Brandon Ayers. You'll get a really nice window, not just into the specifics of what they each do on their own, but really how it all comes together. And so I think you'll really enjoy that. Listen to that family office panel too, so that you can understand how we operate. I want to give you in this episode not as much of a macro outlook. We'll talk a little bit of macro at the end, but really a recap of the rebalance this year and the process. Again, we start this in January with continuing education. We do asset manager events, meaning we go to offsite third-party dinners and due diligence meetings, things like that. pretty much all year long. That starts in January every year. So this is a year-long process. It's not just something that happens in October or November. It goes on for the entire year. It really ramps up, though, I would say, as you get closer to the fall, because that's where we say, okay, out of the managers and the topics we've heard talked about, January, February, March, April, May, June, July, what are some of the things that we're consistently hearing that we want to focus on for this year's rebalance? So all of that comes together starting usually around September time, where we'll start really hitting it pretty hard. We'll have 2 to 3 meetings a week. Then in October, we'll sometimes have 2 to 3 meetings a day. Bon Roth does a nice job on our team of really synthesizing that, scheduling it, putting it together. And then at the end of it, we'll come away with an idea of what does BlackRock think? What does State Street think? What does Vanguard think? What does PIMCO, the bond manager, think? What about Nuveen or First Trust or Wisdom Tree? All these names that you've heard of. It's not that we use them all at the end of the day or even listen to everything they say or take it into like it's gospel, but we at least want to hear what they're saying. We want to hear from their top economists. We want to hear from their portfolio managers. We even want to get a window into what their strategists think, the people who are more trader focused. And then at the end of it, you say, okay, these 3 or 4 kind of thinking this, these 20 kind of think this. We ask the same questions to all of them so you can formulate an opinion on what they're all saying. And then you start to say, okay, if everybody's thinking the same thing on a particular topic, does that mean we want to do it? Or does that mean we want to maybe go against the grain or be a little bit more contrarian? We don't always want to be contrarian. You don't always want to do the exact opposite of what a lot of really smart people are saying, but sometimes you do. And a couple of those examples, we'll talk about them and get into it in just a second. But sometimes you do want to do the opposite, because when you're following the herd, once in a while, the herd goes over a cliff. And it's better not to be with them. It's like your mother told you growing up, just because everyone's jumping off the cliff, do you want to do it with them? No. The answer is, well, hopefully no is the answer. So everything that we do is on a disciplined, goals-based process. And I think this is so important. If you can understand one element from Investor Day, and I said it in my closing remarks, I'll say it today in case you missed Investor Day, but if you can get this one thing right in portfolio management, it's going to be a game changer for your return long term, your ability to stay the course and not panic every time a correction comes up. And that's the simple fact that you don't want to look at portfolio management from a risk-based lens. You want to look at it through a goals-based lens. And what I mean by that is, a lot of places out there, and some financial advisors even, when you sign on as a client, some of you have gone through this, the first thing you do is fill out a risk questionnaire. And that risk questionnaire will say something to the effect of, the market goes down this much, are you comfortable with that? The market goes down this much, could you live with that? How do you feel about volatility? Have you ever sold out of the market during a decline? Questions like that. I'm not saying those are bad questions to ask. Those are important questions, but they're not the most important questions. The most important are the financial planning goals-based questions. And those are questions like, when do you want to retire? How much are you going to need per month when you retire? Are you going to buy a car? Are you going to buy a second home? Do you have college expenses coming up? Those are the important questions that you have to start with, and that's all part of a financial plan. So your investments are not just on an island on their own, or at least they shouldn't be. In a lot of places, a lot of firms, they are. They just only look at the investment portfolio. You fill out that risk questionnaire, and it comes out, and it turns out at the end of the day that you're a 7 out of 10, or you're a 6 out of 10. You're a moderate, you're an aggressive, you're a conservative. Nobody really knows what that means at the end of the day. But in my experience, what's happened is if you start with that goals-based process, you end up with what's called a modern portfolio theory, which is simply buying anything and everything. It's looking at the factors, the value, the growth, large cap, mid cap, small cap, international, US, saying, oh, let's just buy a little bit of everything. And sometimes the factors correlate. Sometimes they don't correlate. Sometimes you want to own momentum. Sometimes you want to own low vol. Sometimes you want to own quality. And I look at that and I go, well, really the only qualifier at the end of the day should be quality. If we're going to buy investments, if we're going to have to be on a financial plan beating inflation for the next 10, 20, 30 years, you could be retired almost as long as you're working, maybe even longer in some cases. Because of that, we have got to have a goals-based plan. The number one goal of any goals-based plan is not, let's limit our volatility. Okay, it's more so that we cannot run out of money or don't want to run out of money before retirement. So your biggest risk, and once you define your risk properly, your risk is that you could run out of money in retirement thanks to inflation. Once you start from that point, you've got your number one goal set. We can fill in all the gaps after that. And I do that a lot with some of our younger clients, kids, grandkids of our current clients that just got started with the starter account. We're helping them out. We're putting a financial plan together. And one of the things we say is always begin with the end in mind. That's one of the habits of highly successful people, Stephen Covey. And actually, when asked, that was his number one habit was start with the end in mind. And really what that looks like in financial planning is start with the very end of the plan. That would be you hopefully, living well into your 90s, passing away, and leaving money to your heirs if you have them, or some other place you want your money to go. And when that happens, we just want to make sure you're not destitute, you're not out of money, right? That's obviously our end goal. Our secondary goals are much easier to kind of work backwards from. So if you start with the end in mind, you think about, okay, let's make sure we don't run out of money. We know the biggest threat to retirees is inflation. Then we can start to construct a portfolio that makes sense. And so this is all of the philosophy, all of the principles, you could call it. I called it 10 rules for investors that go into creating the portfolio. Because if you get this, let's say you're in one of those 60-40 portfolios or 70-30 or even 80-20, if you start to not understand what those two components are for, you can end up with a mathematical mess. And that's really what it is. It's just a mathematical mess. It's not that I think it's not my opinion that it's a mess. It truly is, from a statistical standpoint, not going to help you achieve a goals-based plan. And what I mean by that is a lot of people have gone into the 60% of the portfolio, which is the stocks, and they've gone out and said, let's buy so-called safe stocks, defensive sectors. Let's buy companies that pay high dividends, and not dividend growth, which is great, but just high dividend. And what they've ended up with is a portfolio where the stocks don't really protect them on the downside, because stocks are volatile. Stocks are not safe. They're not secure. They're not conservative. Stocks are the risk factor in the portfolio. They're volatile, okay? And they've gone out and bought stocks that they thought were safe that aren't. But then when the market does go up and technology rallies or big tech goes up or whatever it might be, they don't own enough of those growth stocks or growth sectors to participate in a market rally. So they're not beating inflation. They're not achieving that final goal. Then at the same time, they go into the 40% of the portfolio, which is fixed income. That's really your safety money. And I've said to people, hey, at a minimum, when you're retired, you got to have 2 years of living expenses, probably 3 years of living expenses in something short term that's not going to fluctuate when the market goes down. And we don't need it to rally and spike a bunch when the market goes down, but it's just going to be secure. It's going to be some sort of ability to weather a storm. And they've gone into that part of the portfolio and they've gone aggressive. They've actually done this thing called reaching for yield. And they look at the interest rate environment where interest rates are only 1 or 1.5 or 2%. This is all really during COVID. And they bought these bonds that were long-term, or they bought high credit risk bonds, or they bought high yield or highly leveraged corporate loans, and all these issues where yes, there may be a higher degree of yield and income, but one of the things we like to say at Stenger Family Office is that the higher the yield, typically the higher the risk. And so the part of the portfolio, that 40% that's supposed to be safe and secure, ends up not being safe and secure. And so when you go through one of those downturns, if you haven't gotten the 40 right, you're not protected on the downside. And that's what happened to a lot of people in 2021 and 2022. Stocks and bonds, specifically long-term bonds, got crushed last year. So this is where the 60-40 or the 70-30, the 80-20, wherever you end up, has to be a goals-based discussion. Now, If you're in a 60-40, you've got about 6 to 7 years of living expenses in short-term fixed income in most cases. So we go through a downturn, you're sleeping like a baby at night, you got nothing to worry about. We didn't get compensated to hold that 6 years of cash before, or treasuries. It only paid 0.5% in interest in 2020, and everybody's going, Nick, why do we have 600,000 or $1 million in something that pays us 0.5%? And I said, well, just wait, because if rates go up, we'll be happy we have that protection. Sure enough, rates did go up and we had the protection, so we didn't lose money on the fixed income for our clients. That's such an important component. Some of you are a little bit more willing to take on some more equity risk or equity volatility, I should say. And so instead of needing 6 or 7 years in short-term fixed income, you're more moderate and you've got a 4 or 5 year window built into the cash. And I personally think moderate is where most people should be. I do think there are people that should be more aggressive. And I think if you're actually in the 55 to 60, 65 range for retirement, I do think you should be more aggressive, where you'd only have 2 or 3 years in fixed income. Why? Because you've got that much longer to go where you do have to beat inflation. And if you've got a 60-40 portfolio when you're 65, that may not be substantial enough to beat inflation anymore. It just may not be. So I think you do need to, again, go back to your goals. What do I need per month in retirement expenses? What are the things that are coming up on the docket? Maybe there's some healthcare expense. Maybe I am buying that second home. Maybe I'm buying a car soon. That's the stuff you tie up in the short-term fixed income. You keep your liquidity, you have it there. You're now getting 5.5% risk-free on it. That's what you do with that money. Don't go out and buy these long-term bonds. Don't go out and buy risky stuff. Keep it short-term, keep it conservative. Use the equity part as your alpha generator. And alpha just means excess return. That's where we want to try and buy stocks that are going to keep up with inflation. It doesn't mean that we go out and buy risky stocks. And so with that, I do want to start with, I've got 5 things that we looked at. We looked at obviously a lot more, but 5 main themes that we looked at in the rebalance that we covered, some of which have to do with equities, with the stock side, and some with the bond side. So the first thing is that technology is inherently deflationary. What does that mean? Well, everybody who's worried about inflation, everybody who's worried about the rising cost of goods and services, that labor costs more, that food costs more, that energy prices are up, that housing is expensive, all of those same things that you and I face are also faced by businesses. And what businesses do, if they're a well-managed company, is they're able to beat the inflation over time through a variety of methods. First thing they can do is raise their prices. That's what they did during 2021 and 2022. Procter & Gamble raised prices, Kraft Foods raised prices, all of the things that you said, wow, it costs 10% more for a can of soup at the store. That's what it was. It was our input costs are 10% higher. We're raising our costs 10%. And whether or not those input costs are durably higher, meaning their inflation lasts or not, they're going to still keep their prices higher. That's just how companies operate. So if you raise the price of a box of Cheerios by 10 or 15%, most likely the company's not going to lower the price of the Cheerios by 10 or 15%. That's just part of life. That's inflation. And so if you're an equity owner in the company that's producing these products and services, and then inflation does go down, you're in a great spot, because now you've got higher revenues with lower expenses. Revenue minus expenses equals profit. You got higher profits. And that's why companies are so profitable right now. Now you say, okay, Nick, when all that's over, they probably can't increase their prices another 10%, which you're correct about. I do believe that. I think actually a lot of the price increases are over now. I don't think you can take the price of a burger from $18 to $22. That doesn't work. Eventually what will happen is the companies will process some layoffs and they'll do some cost cuts. And I'm not rooting for this. I'm not saying this is a good thing, but we have lived through a record tight labor markets the past couple of years and record low unemployment. Because of that, we could easily see a tick up in unemployment. You're going to see some bankruptcies. You're going to see some big tech layoffs. You're going to see Fortune 500 say, remote work. We've been tracking people. It turns out 10% of our people really don't do a whole lot when they're remote. I'm not saying everybody who works remote doesn't do anything, but companies do track it, and they know which percentage of their people don't do anything. Because of that, they're going to cut those 10%. I'm telling you, it's just a matter of time before it hits. So that's how they'll protect margins. But the third thing, and this is more positive than those first two, is that technology is consistently being utilized to reduce costs. Companies that are smart, and I'm talking the best and brightest, whether it's the tech company themselves or the company leveraging that technology, are looking at the problems they face and saying, how can we reduce our costs, primarily labor, by using a robot, for example, or hiring some sort of technology provider to come in and do a tech transformation. There's a company out there called UiPath, not telling you to buy it, I'm just telling you what it is. But they do this thing called robotic process automation. Microsoft has a business like this, where they basically take a white collar worker's day-to-day tasks and say which sets of those tasks can we automate, which parts of those tasks can we give to a robot. And that's a positive for company earnings. I don't think it's going to wipe out jobs long term. In fact, all this technology actually creates more jobs. That's been proven time and time again. I won't get into that data right now, but that is a fact. So not only do we want to buy some of the tech companies, but we just have to be careful. We don't want to buy all of the pioneers of technology, because if you go back to 1999, leading up to the tech bubble, you put an equal weight portfolio together. So you bought each one of the top tech companies in 1999, you bought them in equal parts and held them through today, you'd basically have a 0% return. You would not have made money in 23, 24 years. Why? Because a lot of them go out of business. Yeah, a couple of them like Amazon do well, but think about Cisco. Cisco still has really not made it back to record all-time highs, or I just can't remember off the top of my head. It might have just hit it, but it took 20 years, and so that's the problem with buying the technology itself. Yes, some of it makes sense. If it's a profitable tech company, if it has growing revenue, growing margins, then yeah, we're interested. But in a lot of cases, it makes more sense to buy the sectors of the economy that are going to leverage that tech to improve their margins. Easy two examples would be the healthcare sector and the financial sector, like banks. And not every bank's a good buy, I'm not saying that, but banks have been able to close branches and shut down expensive centers where they'd have, a big old branch cost $2-3 million a year to operate. They go online, because most people go on their app to do their banking. They're not going into a bank branch. That's a positive for company earnings. And so, yes, we want to be in tech, but we may want to be just a little bit more careful about not just being only in high octane tech. And we've really stayed away from that. We like the big tech names. We like the names that are in the top names in the Fortune 500, top names in the S&P, where you've got high degrees of operating leverage thanks to tech. So that's number one. Technology is inherently deflationary. Number two, the big get bigger. Because companies are at the top doesn't mean that their winning streak is over. And so investments are not like gravity. Gravity, what goes up must come down. That's not necessarily true in investing. In fact, the opposite is true, that the bigger actually continue to get bigger. That's just a fact of life. And so if you look at the top balance sheets of the Magnificent Seven, that everybody's like, oh, why is the Magnificent Seven outperforming? Well, they're better companies, they're better stocks, they have better earnings, they have better balance sheets, they're operated better, and that's why they're at the top. So the S&P 500 really is a meritocracy. Yes, you've got Standard & Poor's sort of making some decisions, but when you buy the S&P 500, it's essentially a meritocracy. The best and the biggest rise to the top. I don't think that's a trend that's going to stop anytime soon. Now, I will say you could see a correction in some of those names. Microsoft trades at a 35 price to earnings multiple. You could see that pull back in the short term, but that doesn't make Microsoft a bad company. Same thing with Apple. If Apple sells off 20-30%, and it has in the past many times, you buy as much as you can get. These are great companies, and if they go on sale, you want to own more of them. So number two, the big get bigger. Number three, we talked about this, but equities beat inflation. You cannot beat inflation in the bond market. The bond market is essentially 98% correlated to interest rates. So if interest rates are up, then bond yields are up. And you're thinking, wow, I can get 5 or 6% in a bond now. Yeah, but that's only because inflation's up. So if you take a 5% treasury or 5% money market or whatever you're looking at buying in the bond market, you subtract out inflation. Inflation, let's say, is 3.5%. Well, you're left with a real return of a measly 1.5%. In an equity, let's just say total returns on a gross basis, on a nominal basis, are 10% a year. Let's say inflation's 3.5% a year. Well, you've got a much better shot at beating inflation in equities because your real returns are 5 to 6%. So that difference in real returns on a treasury or a money market versus an equity versus a stock, what do you have to pay for that difference? Well, it's just simply volatility. So again, we go back to volatility is not risk. Running out of money thanks to inflation is. So equities over time will beat inflation. What do you have to pay for that? What's your downside? It's just volatility. That's why you buy diversified baskets of securities. We don't want to have your whole portfolio in one company or one sector or one geography or anything like that. But you do want to have companies as the primary positioning in your portfolio so that you don't run out of money. All right, number 4, U.S. beats international. I have talked about this relentlessly on the show, and I continue to say this. U.S. companies are the best positioned to outperform. You say, Nick, what about some of these places in Europe, Japan, China? What about some of these companies? Some of them are okay, and we don't want to ignore those areas as growth spots, but I am much more in favor of buying the United States-based company that's able to sell into that market, access the billion people in China, access the billion people in India, and sell into those areas. But I'm just not overly enthused about the entrepreneurs in those geographies. The entrepreneurs, the Chinese entrepreneurs and the Indian entrepreneurs that have left those places are great. A lot of them actually come to the United States. Same thing with European entrepreneurs and African entrepreneurs, but they're all right here in the US. They've all decided that this is the land of the free and the home of the brave and rule of law and personal property rights, that this is where they want to be. So I'd rather just keep you in the US. And it's hard to replicate US companies abroad. Nobody's been able to do it yet. And so just stay here, stay local. US beats international. That's number 4. And then lastly, short-term versus long-term bonds. Again, we don't overly like to make calls on duration, meaning how long does a bond have until it matures. But the way it works is that a long-term bond is much more sensitive to interest rate increases or decreases than a short-term bond. And that's how all assets work. A long-term asset like a stock, or a long-term asset like a long-term bond or real estate or some of these things, when interest rates go up, they get crushed, they get hit. When interest rates go down, it makes the value of equities much more attractive. So people sell sell bonds and buy stocks. When that happens, and when interest rates are going down, you want to be in short-term assets. So if you're going to make a duration call, or you're going to make a call on the long-term health of the economy, I would say we're probably going to see lower interest rates over the long run. Now, that being said, if you're operating off of that information, then you'd say, okay, I want to go out and buy long-term bonds because interest rates will be, Nick said, interest rates will be lower in the future than they are today. And while I do think that's true, I'm just not sold on the idea of buying long-term bonds because, again, they just don't protect us on the downside. They're overly correlated to equities. And yeah, maybe we pick up an extra couple of percentage points if we go out and buy a long-term bond for you right now. But to me, it's just not worth the downside. So I would stay very conservative with your bond portfolio. I would keep it short term, short duration. Now, at some point, maybe you go out and buy 3 or 4 year or 5 year bonds. I could get on board with that at some point. I still think it's too early. But as far as going out and buying 7, 8, 9, 10-year bonds, I think you could be in for a world of hurt just in case inflation isn't completely in the rearview mirror. So those are the 5 themes we looked at. I would encourage you to watch the replays. You'll get a lot more in-depth information on what we're doing behind the scenes for you. And that's just a little bit, that's just the tip of the iceberg. So go ahead and watch the Rebalance replays, watch the rest of it. We'll send it out to you. Eventually it'll be on YouTube, and we'll get that out to you. But thank you for being with us. Thank you so much for jumping on episode 135. hoping that you have a wonderful Thanksgiving week next week, and enjoy your family and friends, and eat lots of turkey. I hope you enjoy and think about all the wonderful things we have to be grateful for this time of year. We are living in the best country on earth, the best economy on earth. We have some of the best healthcare we've ever had access to. People are living longer than they ever had. We've got just some wonderful things to be grateful for. And if you focus on those things to be grateful for, you will quickly forget about all the doom and gloom, all the reasons to be negative. There's always going to be reasons to be negative. I talk about it each week on the show, the doom and gloom, the relentless negativity. But if you focus on that, it can lead you to make some bad decisions. So focus on the gratitude, focus on the optimistic reasons backed by data to stay on your plan. I think if you do that, you'll find there's plenty to be grateful for. There's plenty to be positive about. And pretty soon I'll be giving you my year-end outlook and 2024 projections. So stay tuned for that. But I do think over the next 12 months, we are going to be pleasantly surprised with where the market goes. Thank you for being with us. Again, this was episode 135. We'll see you next week for episode 136.